Hello and welcome back to Game of Trades. My name is Peter and I'm here to help you navigate through this crazy market. Now the S&P 500 has been dropping off over the past couple of days. We've had quite a nasty 4% correction with a rapid drop. Now this is a correction that we've been expecting, that we've been talking about ever since we hit that resistance level. So we were looking at this bull flag right here, a nice impulsive move to hit that long-term resistance. Then we had an impulsive breakout that was all bullish technicals, and then we hit that resistance and started to grind sideways. So that's a bearish development right here. You don't want to be taking long positions near resistance, but now we're coming back down to test that trend line, which was broken here. So we're near support. So here we have to ask ourselves, is this the right time to buy, or are the markets just going to cut through that level like it's nothing and come back down to these levels right here? And that's exactly what we're going to cover in this video. We're going to go through everything that's actually relevant, every indicator that can help us with this market correction. So without further ado, let's get right into it. Now, just looking at the price levels, this is a beautiful textbook breakout and back test of a very strong level of resistance that's become support. So if we find support right here above this trend line right here, and the S&P 500 actually closes above this trend line this week, then we'll be looking for new all-time highs next week, potentially reaching much higher levels over the next few weeks. But if we begin breaking down here, then that would make this a false breakout, and we could see a drop back down to 3,500 points and even potentially much lower, because that'd be a very bearish development right here. So let's take a look at the indicators that are actually going to help us find out if we're going to hold that level or not. So let's first take a look at the VIX, so the volatility index of the S&P 500. You get spikes in volatility during market corrections, and when the market rallies, you tend to see the VIX come down. So that's what we've seen since the March bottom. We've seen volatility decrease massively all the way down to that 16-point level. But you can see what I've highlighted on this chart here is a nice price channel of the volatility index that's actually well respected. We've got a few reactions off this level, right, holding many of the spikes that we've had. The bottom of this channel holds as support all the way through. And what's happening right now, we're testing the top of that channel. So we're in a downtrend in volatility and we're testing resistance. This is a great moment to be buying the stock market, despite how aggressive the sell-off has been. Now, if we start to see a move through this line of resistance, then all of a sudden the VIX is outside this downwards price channel, and we'd be looking for a larger correction than anything we've seen over the past few months. So that's why you need to be flexible in your trading. While this is looking very bullish for stocks right now as the VIX is at resistance, if we have a breakout here, you have to be able to switch your narrative to much more downside on stocks. Now, the next thing I want to take a look at is the dollar. This is the US dollar index. We've been following this for such a long time, and it's been the absolute best predictor of where stocks are going to be going. When the dollar goes down, stocks tend to go up, and when the dollar is rallying, that's when you're going to start to see a little bit more pressure on the S&P 500. Now, you can see what's been happening recently. We've been in a very strong downtrend on the dollar right here, so a very bearish trend, so bullish for stocks. And we're just below this line of resistance. So this is a downtrend line resistance, and we're still below it on the dollar. So if we get a rejection here, that would mean another leg down for the dollar and another leg up for stock. So this is looking bullish for the S&P 500. Now, something to watch out for, and that could completely change the picture, is if we break out here. If we break out above this downtrend line resistance, then you'll notice what's happened here. We had a nice trend line of support all the way through, and then DXY broke down below it. But if we break out through here, that makes this a false breakdown, and that could open the door for much more upside on DXY. So again, very similar to the VIX, we're bearish on the dollar, and so that's bullish for stocks. but we're really at a turning point. So if we see more upside on the dollar, our narrative will change from bullish on stocks to very, very bearish on stocks. Now, the next chart that I want to show you is probably the most important in this video, so pay attention very carefully, and also make sure to hit the like button if you're so far enjoying this video. We do the research, we give you guys our convictions, what we're doing, what's going on through our minds as we're seeing the markets move. So if you like that approach, if you like that transparency, make sure to hit the like button as hard as you can, and also visit our website at gameoftrades.net. We make frequent up-to-date articles on the stock market and on other opportunities we see in the markets, precious metals, emerging markets, cryptocurrencies. And when we actually have convictions, we have trade setups with specific targets, stop losses, and the actual reasoning behind that trade setup. So back to what's happening with TLT. So this is the Treasury Bond ETF. And before I actually take a look at what's happening, I want to discuss the relationship between stocks and bonds. And it's actually very simple. It's an inverse correlation. And I can show you that by just adding the S&P 500 on this chart. And so we've got the S&P 500 in orange right here. And you can see a huge part of the rally that we've had on the S&P 500 has been accompanied with a drop in bonds. And that's very simple to understand. As investors exit bonds, they tend to enter stocks. It's a question of asset allocation. And we can go back much further and you can see how powerful this relationship is. As bonds go up, stocks will tend to go down. When bonds go down, you tend to see stocks rally. And it's actually pretty surprising how strong that relationship is. You can see right here in 2010, just before the big market drop that was around 17%, you had bonds test very strong support and start rallying. And same thing here in 2011, just before a big drop, you had bonds bottom, test support, and start to rally. So now that we've understood that relationship, we can take a look at what's happening on the bond market from a technical standpoint. We've been following this price channel, very accurate and well-defined price channel, capturing all these reactions at the bottom of these moves as well, very strong reactions. And we've also got a nice middle line right here that does act as resistance and support when tested. And look at what's happened right here. We had a powerful breakdown through that line, then a back test, and look at this candle, this weekly candle, a big rejection. So again, what does that mean? Does that suggest that we're going to see a large correction in stocks? No, absolutely not. This is bearish for bonds and bullish for stocks. Now, can this start to turn around and start to rally? Absolutely. And if that happens, we'll change our narrative from bullish on stocks to bearish on stocks. But right now we're trading the chart that's in front of us, and we're seeing a decline in bond prices, and that's usually accompanied with a rise in equity prices. So the fundamental picture in the stock market has not changed, right? We're still bullish on equities. We still have the Federal Reserve expanding their balance sheet. We've still got more stimulus likely to come. We've got vaccination optimism picking up speed. So right now, there's nothing much to worry about unless we start to really break down back into this price channel. That will start looking very ugly for the stock market. If we have this type of move, we would be looking for much more downside on equities. We're following the chart that's in front of us. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.